Home sales fell nearly 6% in July as housing market slides into recession. That was a headline this week from Diana Aulick, housing editor for CNBC, someone whose predictions consistently generate clicks but are not necessarily reliable, at least in my opinion. Hey, it's Eric Osses here from Homebridge Financial Home Mortgage with my weekly update on mortgage rates and the economy for the week ending August 19th, 2022. Is our housing market really in a recession? Well, let's take a look. Existing home sales in July were indeed down 5.9% from June, and that's 20% lower year over year. But keep in mind that mortgage rates peaked in mid June, and I think that had a lot to do with the lower sales activity. There's no doubt that activity has slowed, but there's a difference between lower housing activity and a price recession. It's a stretch, I think, to forecast a price recession when inventory levels are so tight. Nationally, we have only about 3.3 months of inventory. Locally, it's even worse than that, around 2 months. A normal inventory level is 6 months, which is considered a balanced market. We'd be concerned if the inventory levels rose above 6 months, but that's not really likely. Another example is housing starts. Last month, 1.4 million new housing starts, homes coming up out of the ground, but we had new household formations at 1.7 million. So the number of new households being formed is still exceeding the supply, the number of new homes being built. And as long as that trend continues, we will keep seeing a shortage of housing. In the Great Recession of 2008, in contrast, we had over 18 months of inventory. That was an entirely different situation, which combined with rampant speculation and a heavy dose of easy lending, it led to a bubble and ultimately a crash. With housing inventory levels at only 2 months right now, we just don't see that happening. And inventory is probably at its highest point of the year. Listings are seasonal, and they usually peak in the summer before tapering off in the fall. Also, homes are not sitting on the market very long. The average home on the market right now is only on 14 days. So, sorry, Diana, the statistics just don't point to a housing recession, at least not at this time. In other news this week, we received better than expected unemployment numbers, with initial jobless claims last week down 2,000 to 250,000. And Germany shocked us this morning when their producer prices rose a staggering 5.3% in July on a forecast of only 0.6%. Higher energy costs in Europe are really taking their toll, especially in Germany, which is the largest economy in the European Union. The bond markets were not super thrilled at all about these numbers, and mortgage rates ended the week slightly higher. Here are the national averages. A conventional 30-year fixed rate mortgage, 5.48%, that's up 0.21 from a week ago. 15-year fixed rates, 4.81%, up about 0.23. FHA and VA 30-year fixed rates, 4.83%, still under 5, up about 0.15% from last week. And 30-year fixed rate jumbo loans, 4.75, that's up just slightly, 0.07% from a week ago. So these higher prices and the rates still being elevated, although better than they were, is really taking its toll on first-time home buyers. First-time home buyers last month made up only 29% of home purchases, down from about 30% a year ago. A small drop, but for first-time home buyers, they're really feeling the pinch of higher prices and rates more than others. So here's a few strategies that can make home financing more affordable. Number one, temporary buy downs, otherwise known as a 2-1 buy down. That can make a huge difference in your monthly payment initially. A 2-1 buy down gives a temporarily lower interest rate, 2% lower in the first year, 1% lower in the second year, and then reverts to the market rate for years 3 through 30. The strategy there is to take advantage of the lower rates for a couple of years while waiting on mortgage rates to fall, which we think they will, then refinance into a permanently lower rate. The seller on a 2-1 buy down is required to pay the cost of it, which is about 2.25 points. You're essentially prepaying the interest. And we have a few transactions where the sellers have been willing to do that recently, again, with this shift in our market. What about a permanent buy down, otherwise known as paying points? You can pay an upfront fee, points, which are tax deductible, for a permanently lower interest rate. 1 point costs 1% of the loan amount. And 1 point will typically lower the interest rate about 0.25%, although it varies a little bit right now in today's goofy market. If you compare the savings you get from the lower rate to the cost of paying points, it usually takes about 5 years to break even. So paying points is a good option only if you plan on keeping that mortgage for a long time, or if you can persuade the seller to pay the cost of those points. Another option is ADU income. Buy a home with an accessory dwelling unit. Freddie Mac is finally allowing income from accessory dwelling units, ADUs, to be used to qualify. If the home has an ADU, it's got to be a separate living space with a separate entry. We can add 75% of the market rent to your qualifying income. The same formula works if you buy a 2 to 4 unit property, although those properties do require a higher down payment, 20 to 30% down versus 3% down for a single family home. Another option would be to add a co-borrower. Add a parent, friend, cohabitant to the mortgage. That's a time-tested strategy. We just combine everything together, all the income, credit, and assets, and qualify you on that combined total. There are a couple things to know, though, if you're thinking about bringing on a cosigner. Number one is that the mortgage will show up on their credit report, and the only way to remove a cosigner from the mortgage is to redo the mortgage, to refinance. Another option is down payment assistance programs. If you earn less than $160,000 in Washington State, you can get down payment assistance up to 5% of the sale price. That money can be used to pay the down payment, closing costs, anything like that. These programs do carry a higher interest rate, so it's not perfect, but they certainly solve that not enough money in the bank situation. I love working with first-time homebuyers. I actually teach homebuyer education with the Washington State Housing Finance Commission. If you're interested in learning about classes that are forming, just reach out to me. I'm always happy to meet one-on-one to discuss any of these strategies and help you get into your first home. Hope this information is helpful. Have a great week. You can reach me anytime, 206-915-3742. You can email me, eric@ericismybanker.com. Don't forget to subscribe to get this weekly update on rates, and I'll talk to you next week.